Convert to a totally tax-free strategy with no strings. In this episode, I'm going to answer the question, what to do after maxing out 401k and Roth IRA. You're going to be blown away with my answer, and maybe you will even redirect the money you've been putting into an IRA or a 401k or a Roth. So my name's Doug Andrew. I've been a financial strategist and retirement planning specialist for more than 4.5 decades. So I've helped many people prepare for retirement. To be honest with you, I've never owned an IRA or 401k. Never will. I've never owned a Roth IRA or 401k. I never will. And the majority of my clients do not own IRAs or 401ks or Roths. So you need to know that from the outset, and you're going to understand why. Let's answer the question, first of all, what to do after maxing out a 401k and your Roth. See, those types of qualified plans only allow you to put contributions into a certain dollar amount or a certain percent of your income. So if you're asking that question, you've put in the maximum amount allowed by the IRS into your 401k or the maximum allowed into a Roth. Because many people have more money that they want to save, and kudos to you if you have that, then you can contribute into those vehicles. And so, first of all, I would recommend that you only contribute to a 401k or one of those plans on the amount that maybe you're getting matched from your employer. If you put in $1 and your employer matches 50 cents on the dollar, now you got $1.50. People think they're earning a 50% rate of return. No, you're not. You started out with 50% more, and that basically covers the future tax liability, because if you put in $1 and your employer gives you a 50-cent match, you got $1.50. If you pulled out $1.50, if you were vested, you pay a third, 50 cents on that $1.50. So 50% employer match is covering your future tax liability in a 33% tax bracket. Does that make sense? So that's okay. But there's a lot of other factors. Many times people don't realize the rates of return on traditional IRAs and 401ks in America is only 3.5%. And people say, well, my advisor says if you buy and hold, the average is more like 9.6%. Well, that's before tax. That's true. If you earn 9%, you're only netting 6% after you pay tax when you take out the money. But most Americans aren't earning that. Why? Dalbar says most people who have money in the market, they panic when the market starts to drop 20 and 25 and 30%, which it's done, golly, 3 or 4 times in the last 20 years. And they panic and they sell low. And then they wait until the market comes back to here. And then they buy high. And so the average investor return is really only 3.5% because they're buying and selling at the wrong time. If they bought and held, they might average 9, but really only net 6. My favorite vehicle that's totally tax-free, I call it the laser fund, and you'll see why here in a moment. I've been averaging between 6 to 10% rates of return. Really, for the last 45 years, 8.2%. When indexing came out in 1997, I've actually averaged 10.07% by rebalancing, and it's totally tax-free. So it knocks the socks off of a 3.5% rate of return in an IRA or 401k, and that's even before tax. See, a lot of people that maybe accumulate $1 million nest egg in their 401ks or even a Roth, if it's in a traditional IRA or 401k, and they pull out the financial services industry standard of 4% a year, that would be 40 grand, but they have to pay tax in a 25% bracket. That's 10 grand on the 40,000. They're only netting 30,000. Then you have to subtract the fees. 1% fee is traditional on a $1 million nest egg. That would be 10,000. I mean, after taxes and fees, maybe you're only netting 2%. How pathetic is that? So I would rather have a rate of return that is averaging more like 6 to 8 to 10%, because that is triple, quadruple, 5 times what a net after tax and fees IRA 401k is generating. Plus, most people when they retire are not in lower tax brackets. There's exceptions, What are the exceptions? If you don't save very much, who wants to be in a lower bracket because they didn't save very much? If you have saved a lot, you end up in a higher tax bracket because you've been killing your deductions as you went. You paid off your house. You don't have that deduction. The kids are gone. If they're not gone, you can't deduct them anymore. You're not contributing money to IRAs and 401k, so you don't have that deduction anymore. If you're a business owner, you don't have those deductions, and Congress keeps raising taxes. So people find themselves in a higher tax bracket when they retire, and they go, golly, whose retirement was I planning anyway? Mine or Uncle Sam's? So I show them how to redirect that, do strategic rollouts, get their money out of those IRAs or 401ks into what I call the laser fund, and they increase their rates of return, and they are totally tax-free. But when people ask the question, hey, after maxing out my 401k and my Roth, a Roth is tax-free when I take it out, where do I put more money? Well, when I show them the laser fund, they put two and two together and they go, whoa, I didn't even know this existed. This is what savvy CPAs call the rich man's Roth. Why would I ever continue to put money into a 401k at the maximum amount or a Roth? My heavens, can I just roll it all out of then? I go, yep, you can. Read this chapter in this book. Let me show you how to do that with the least tax impact or consequence. So the laser fund has the two advantages of a Roth. It accumulates tax-free, and you can take it out tax-free, but it has 4 additional benefits. See, Roths and 401ks, with the question, I've maxed it out, you can set up a laser fund to put in 300 grand a year. You can't do that in a 401k or a Roth. That's why I've never owned any of them. See, with the laser fund, I could put in 300 grand. I don't have to. I can put in 30,000. I can make up for the other 270,000 anytime I want. You can't do that with a Roth or a 401k in a given tax year. If you don't use the room or the maximum amount allowed, you've lost it forever. In a laser fund, if I put in 300,000 and 30 days later I want 250,000 back out to use in my business, I can do that. There's no penalties. You can't do that with a Roth. You can't do that with a 401k without incurring penalties and tax. I can use indexing where I make money when the markets go up, but when the markets go down, I don't lose because my money is not in the market with a laser fund. I get to benefit when the market goes up, but I don't lose when it goes down. And when I ultimately die, my laser fund doubles or triples and transfers income tax-free. Every million, if I died right now at age 68, would blossom to 2.5 million. There's not a Roth around that will do that. And people say, how much does that cost? Nothing. It's being paid for with otherwise payable tax. Nothing's free, but I'm not paying for it. It's being paid for with money most people shell out in unnecessary tax sooner or later on 401ks or even Roths. So if you want to learn more about what I'm talking about, I've written a book, 300-page book describing the laser fund. LASER is an acronym that stands for Liquid Asset Safely Earning Returns. How to diversify and create the foundation for a tax-free retirement. It's 300 pages of charts, graphs, and explanations, plus you flip it over. This contains 12 chapters with 62 actual client stories. So if you want to claim your free copy, here's how you can do this. Go to Laser Fund, L-A-S-E-R, laserfund.com, contribute $5.95 towards the shipping and handling. I'll cover the rest, and I'll pay for the book. I want to empower you. I would encourage you to subscribe to the channel, hit the notification bell. Every day I post an answer to a financial question like this one, and I'm passionate about educating you on how you can optimize your assets and minimize taxes.